Way.
We set?
All set.
Okay. So we are another group talking about COVID and the economy, but our focuses are inflation, GDP, price stability, and the stock market. And so before we look at these in relation to COVID, we wanted to give a little background. Let me go to the next slide. So GDP is the total value of all final goods and services produced within a country's border in a given year. And one way to think about this is by adding the totals for consumer, individual expenditures, investment by businesses, government spending, but not including transfer payments like welfare and social security, and then also adding net exports, which is just exports minus imports. And GDP is important because it tries to capture the state of the economy in just one number. And so in theory, we can look at this to see how the economy responds in a specific year. But there are limitations to this. For one, it excludes underground transactions, so we can't truly account for all of the economic activity. So this includes non-market services, like getting a ride from a friend instead of an Uber, and also illegal transactions. GDP also doesn't account for negative externalities or the sustainability of the.
I have to carry him up.
The sustainability of the economy in the long term, because it's only looking at that one type of data point, which is that total value of goods and services produced.
Look, we're light. So.
And so GDP can't tell us anything about environmental impact or the impact on human health.
I'm going to just mute everybody, so please unmute yourself if you're speaking.
Okay. So GDP also doesn't account for those negative externalities or the sustainability of the economy in the long run, because it's only looking at that one data point, which is that total value of goods and services produced. And so we don't know anything about environmental impact or the impact on human health coming from the production and consumption. And there are other limitations, but the last note I want to make here is that GDP or GDP per capita is not an accurate measure for economic well-being because it doesn't account for wealth inequality. It just looks at the output as a whole for the country. It also doesn't account for purchasing power or what people can do with that money. So that's also something to consider. And then we can also look at it as either nominal GDP or real GDP. Nominal GDP is the raw number that we get when finding that total value of goods and services produced within a year for a country. And it doesn't account for inflation. And so because of that, the number can change with a change in price or output, when really we want to just focus on output with GDP. And then real GDP looks at the total value of goods and services, but valued at a base year's price. And so in doing this, it accounts for inflation. And so because of that, real GDP should only change if output changes, which is what we normally want to look at. And this next slide just shows a simple typical business cycle, which includes periods of economic expansion, then a peak, then a recession, then a trough. And it shows that there's an upward trend while the cycles continue to play out, which is expected. And then on the next slide, we see that real GDP has grown somewhere around 2% per year historically, with especially significant fluctuation corresponding with recessions, which you can definitely see here too.
So now we're going to look a little bit at the impact of COVID-19 on US real GDP. And we usually look at real GDP because the numbers would be a little bit skewed if we include inflation numbers in calculations. So this graph is from the St. Louis Federal Reserve Bank. And this is just over the past 13 years to highlight the difference between the Great Recession in 2008, 2009, and the impact of COVID, at least on the data we have so far on the first couple quarters of 2020. And in the second quarter of 2020, real GDP in the US fell by 9.5%. And this dwarfs the Great Recession because the maximum quarter decline in the Great Recession was only 2.2%, and that was in the fourth quarter of 2008. And in the Great Recession, it took about 3 years for GDP to reach pre-recession levels. And this is because, as we'll see later in our analysis of the stock market usually makes more V-shaped recoveries, and it's much more volatile, but GDP usually takes a little longer to recover, and the recoveries are usually more U-shaped. And these two graphs show kind of the general trend of real GDP over time since 1950. The top graph is just real GDP in changed 2012 dollars, which is basically just a unit that is used in order to keep everything on the same level. And I'm not going to go into too much detail on that, but the basic idea here is that you can see from the graph that there hasn't really been as sharp of a decline in real GDP since 1950 as we saw in the last quarter. And in comparison to some other recessions that are highlighted in gray, you can see that there's a much sharper decline. And the graph on the bottom is real GDP per capita. So this basically just takes into account growth in population. And you can see that this graph is a little more linear, but the same kind of idea holds, where real GDP dropped a great deal more than it has over the past 70 years. So why has GDP declined so sharply? So as I said before, it fell 9.5% in the second quarter, which if you hear people say GDP fell by 40%, they're usually superimposing the second quarter figure over an entire year to say, if GDP dropped at this rate for an entire year, it would fall 40%. So that figure can be a little misleading. But the main reasons for this are that consumers cut back spending and transition to less in-store purchasing and purchase more things online. So fewer jobs are needed for this, and that really hurt the retail sector and the restaurant sector because people can easily move away from in-person options and transition to lower contact options and online options where fewer jobs are needed. And additionally, many small businesses had to shut down, especially in the restaurant sector. And this created a lot of unemployment. And you can see here on this bottom graph from Business Insider, this graph basically compares the COVID-19 unemployment rate to the Great Recession unemployment rate. And you can see that there's a much more drastic spike in the unemployment rate due to COVID-19 because of these mandatory lockdowns and because it happened at such a rapid pace with these shutdowns, and they were so widespread that forced a lot of people into unemployment. And as I said before, retail was hit especially hard by this. As you can see, compared to the Great Recession, retail and food services sales took a much sharper hit. And the data is still fresh because it's only been a few months, but the Great Recession didn't see a decline anywhere near this sharp. And this caused a lot of major retailers to file for bankruptcy, such as Neiman Marcus, Sears, and JCPenney. And there were some winners, as the group on Monday mentioned, and some of these were online and digitally based, such as streaming services, Netflix and Hulu versus movie theaters, or online retail options such as Amazon, where fewer jobs are needed.
So we're going to shift to talking about the stock market. So some quick background before we do that. Stock represents ownership of a small piece of a company, and stock is divided into shares that can be purchased by the public for publicly traded companies, and businesses do this to raise money. And the prices of stocks are based on expectations for future company earnings. And the stock market is made up of exchanges, which are marketplaces where the shares of publicly traded companies are bought and sold. And so notably, there's the New York Stock Exchange, which is the largest stock exchange, and there's the NASDAQ. But NASDAQ is also used to refer to the NASDAQ Composite, which is a market index. And this includes prominent tech companies like Apple and Microsoft and Google. And investors use these market indexes to gauge market movements and track the performance of a group of stocks. And then a stock market crash occurs when there is a sudden severe drop in the stocks, and a stock market correction is a less sudden and severe drop of about 10 to 20%. from the most recent peak.
So this graph basically shows the Dow Jones Industrial Average over the past 25-ish years. And I mentioned before the V-shaped recoveries of the stock market as opposed to the U-shaped recoveries of GDP. And you can see here, just from the shapes of the rises and falls of the Dow Jones, you can see they're much more V-shaped and quick to recover. And compared to the real GDP graph, which is fairly linear over the past 70 years, this graph is anything but linear. And there is a positive upward trend in the long run, but there's much more volatility. And you can see that the sharpest decline was either in 2008 or in 2020. And the recovery in 2020 was much quicker, and the stock market has already rebounded from its crash in March. Whereas in 2008, because the circumstances were different and it was more of a financial crisis rather than a health crisis, the recovery took longer, and the market performance was overall worse than it was in 2020.
Great. So now to talk a little bit more about what happened back in February and March. From February 20th to March 23rd, the NASDAQ fell by 37% and the Dow fell by 29%, really based off of global economic shutdowns, the panics of buying and supply issues for pandemic goods, and kind of a mass hysteria that took over the world. So without getting into too much of the science of trade volumes and yields over the course of February and March, the main things to take away is that the crash occurred simultaneously with the shutdown and belief that the virus would not be contained, and really just those shutdown measures that would severely impact output. As you can imagine, with this, the major industries hit were energy, manufacturing, and discretionary spending, as the demand outlook looked weak. So really, as you see, the page is divided in half. What caused this rebound towards that later end of, or the beginning in March, April into May? As the group discussed on Monday, the impacts of the stimulus package to Americans, as well as the Fed intervention, helped both consumers and businesses. And also, I think once the market saw how China had recovered after its peak number of cases in March and April, investors started to price in this demand recovery towards the end of 2020 and 2021, which really kind of sparked the market rebound. However, as you know, even though the market had recovered around May, America and the world hadn't, which shows, as we will get into, that the stock market may not be the best proxy for economic and social well-being. And kind of just the takeaway from this slide is the market fell with the onset of Corona, but recovered way before the world did. And part of this recovery was exacerbated by boom in tech stocks, as Alex will get into. This next slide that we're just on shows that the different performance based off various industries, and I'll pass it off to Alex to talk a little bit more about specific companies.
Yeah, so I'm gonna look at 3 stocks here just so everybody can see kind of how the group on Monday talked about industry performance throughout the pandemic, and that is reflected in the stock performance of certain stocks in different industries. And on the previous slide, the internet retail industry was the biggest winner, increasing by 63% over the time period mentioned in the graph. And Amazon stock performance is reflected by this. They're up 71.8% year to date. It might be a little hard to see on this graph, but they started at just under $2,000 at their stock price at the start of the year, and they're now well above $3,000. So their growth was strong pre-pandemic, as you can see in this early trend leading up to March, and they did take a hit when the pandemic came. But overall, the coronavirus helped accelerate Amazon's business as it accelerated the movement towards online retail. And additionally, for Amazon, some of their subsidiaries were a factor in their success, because some of their subsidiaries are Whole Foods, which is a grocery store, and grocery stores have performed well amid the pandemic as people transitioned away from restaurants and more towards eating and cooking at home and shopping at grocery stores. And they also have an Amazon Prime video and movie subscription service. And movie theaters have performed very poorly during the pandemic, and people have switched to subscription services such as Netflix and Hulu, and Amazon Prime Video is one of those subscription services. And another one of their subsidiaries is Ring, which is a smart doorbell business. And as people spend more time at home, this may cause them to buy smart doorbells or invest more in home security. But I'm not sure how high of a degree the pandemic played in Ring's acceleration, as they tripled their business towards the end of 2019. So, but overall, Amazon as a business and its subsidiaries as a whole all performed very well during the pandemic. And you can see from this 5-year trend that 2020 has had the sharpest amount of growth over the past 5 years. And another company that did really well during the pandemic was Clorox. And this one is kind of for obvious reasons, as there have been many stories about how nobody can find Clorox disinfecting wipes, and their demand skyrocketed during the pandemic as people wanted to be healthy and safe, and there's much more cleaning regulations now than there were last year. So the demand for Clorox went way up, and their stock reflected that, increasing 41.2% year to date. And they are owned by Procter & Gamble, but they operate independently. So that's why they have their own stock. And their growth spike was abnormal if you look at the 5-year trend in the graph on the bottom, as their stock price had been somewhat stagnant, maybe only increasing with inflation, but there was a huge spike in 2020. So it'll be interesting to see how the stock price fluctuates based on vaccine developments, and whether or not the stock will fall back down to earth if a vaccine does come, or whether it will be able to maintain or even increase growth. And finally, the third stock I want to look at is Hilton Hotels. And with all the travel bans that have occurred over the past 6 months, the Hilton Hotels brand has struggled, and their stock has declined over 20% year to date. And Hilton Hotels is a group of hotels, so all of their subsidiaries are hotels. So they didn't have too much diversification in their group of corporations. And so their stock price plummeted 50% in March, which, and they were forced to shut down many hotels in major cities. So this is a likely reason that their stock price declined. And they have slowly recovered since March. But I want to pose a question to everybody watching, and you can throw answers in the chat. So how long do you think it will take for the hotel industry to recover? And this goes into a debate with a few other industries, such as the airline industry, where experts have estimated that it will take the airline industry over 5 years to recover.
Great. So this next slide looks at historicals comparing the different industries across different countries. As you can see, a lot of countries followed similar paths to recovery, but the natural question that arises as you see these differentiating rates of recovery is, are there policies among countries that cause these different rates of recovery? But to answer this question, we must acknowledge the shortcomings of looking at the market alone. So on this next page, you see that even though the market was recovering, second quarter year-over-year GDP was substantially down across the globe. As the group got into on Monday, both unemployment was at an all-time high and consumer spending took a major hit. So kind of just using those last two slides together, you see that the major takeaway is that you really can't look at the market in terms of looking at the impacts of COVID on well-being. And kind of just to sum up where we're at in terms of GDP and the stock market, on the next page, we go over some pros and cons of looking at the various metrics. Like first, in terms of GDP, it can be good because it's a reliable measure that allows you to compare country data. However, as Amelia got into, it does not account for quality of life or standard of living, as well as unemployment, among other things. So transitioning to the stock market, you see it's good for kind of pricing in future expectations and future consumer spending. However, falls short on a lot of fronts, including unemployment. It can sometimes be difficult to compare across countries. And like GDP, does not account for the standard of living or the wealth gap. So I'll now pass it off to Peter to look into some other metrics, namely price stability.
Yeah, thanks, Nick. And that's a good transition into my section here. I'm going to be talking about price stability and why it's important, namely inflation and deflation. Just a little bit of kind of, background fundamental stuff. Inflation is calculated as a monthly percent increase in the price of a basket of goods. And it's, kind of a wide variety of goods and services as determined by the Bureau of Labor Statistics. And, I think COVID, obviously, as we've discussed, caused a lot of uncertainty and a lot of, a large economic shock, both, originally in March and still to this day. And, as Nick and some others mentioned, we see the stock market recovering, but it's kind of unclear as to whether that's more of a function of people trying to kind of guess the bottom and ride the wave up, or whether it's, a real indicator of the economy recovering. But I think inflation is a really important metric to look at here. And also, in the international stage, I have this little graphic down there. It's an indicator of, if it's inflation, it's decrease in the purchasing power of a country's currency. Obviously, some inflation is healthy and natural and always happens. A cup of coffee was, 20 cents 80 years ago, and now it's, $5 at Starbucks or something. But too much inflation is definitely harmful and can always border on hyperinflation. So, the more I kind of looked at inflation during the pandemic, the more I kind of got the idea that maybe we're not seeing the whole picture. Inflation is, a metric that's not, it is calculated monthly, but sometimes it takes a while kind of for inflation to hit. It's more kind of on the back end of certain, economic crises. But what we've seen is that the overall, prices of goods do seem to be rising at steady rates. The government suggests that inflation's roughly 1% year to date. But, to me, and I think, this is kind of, it becomes increasingly evident that this isn't really the full story. We've seen that the CPI, Consumer Price Index, of essential consumer goods has actually risen. So, that's stuff like groceries, medications, kind of your everyday purchases, necessities. And of course, that makes sense. People, despite a pandemic, need groceries. They need medications probably even more, and those kind of essential consumer staples. On the other hand, as it has been touched on by a couple people here, the CPI of non-essentials has fallen considerably. We've seen airline tickets, gasoline, retail clothing, various non-essential goods, and kind of just larger purchases maybe fall pretty significantly. We have that picture. I have that picture down below of the airline with only a couple passengers. Of course, this is not exciting or revolutionary, but it makes sense. But ultimately, what these two things are doing, or what these two trends are doing, they're serving to balance out inflation, as a much steadier rate than maybe it actually is. I think if you actually take into account, the goods that people are demanding and consuming more, during a pandemic, then maybe we'd see a little bit higher rate of inflation. But of course, the government, that's not exactly in their interest, and so we see about 1% year to date. So of course, what this really boils down to is kind of this bifurcation between the cost of living and the cost of goods. We have this large hole in the economy, and Trump and the government, they've been trying to kind of fill it. We've seen things like stimulus packages. We've seen other support mechanisms. Of course, too much stimulus, too much support means inflation on the back end, and too little means deflation. And that's kind of the balance the Fed and Trump and the administration kind of have to try to strike. But what we're kind of not seeing, taken into account so much in these statistics, and maybe why some of them are not as well representative as they could be, is the actual cost of living during a pandemic. So obviously during a pandemic, wages fall, income falls, real output falls, and it doesn't, and certain and those metrics aren't calculated using inflation adjustments, or sorry, they are calculated using inflation adjustments, which doesn't take into account like actual poverty falling or certain various costs of living during a pandemic. I think, I guess just some basic questions for you guys are whether we will see serious, sorry, I'm just got knocked out here. Whether we will see serious inflation on the back end of COVID, whether it's necessarily harmful or not, whether inflation is a good metric to be looking at here, or whether we should really be looking at other things like like the demand at food banks, or the poverty rate or the unemployment rate. I think inflation is a good metric and is a necessary metric, but I also think it has its flaws, and that it has to kind of be taken with a grain of salt, especially during a global pandemic. So just feel free to answer those in the chat, and I'll hand it off now.
Hi, thank you, Peter. I'm going to talk about inflation and how inflation now compares to that of the Great Recession. So to compare these times, I found this chart that gives a full comparison of those two time frames. The recession started in December of 2007, yet it took more than 9 months for the inflation rates to drop to the lowest levels. Through this chart, we could also see that as the economy worsened during COVID-19, inflation decreased. However, this drop-off was much quicker. The pandemic really hit the United States in March, and the inflation rate immediately dropped and hit its low by April. This makes some sense because the recession would take a gradual path where over a period of time the economy got worse and people were losing jobs and income in the stock market. With the pandemic, it hit all at once, and we went from an open economy to a lockdown in most states, causing the economy to crash quickly. We could pinpoint a weekend, March 13th to 15th, when everything came to a halt. The trajectories of the two events is what makes the difference in how quickly the inflation rates decreased. The rebound is also different because between the two events. The recession took a long time for the inflation rates to increase again. During the pandemic, the drop in inflation has not gone as low, and it is showing a rebound at this time. As we head into winter, where we expected to see another peak in the cases of COVID-19, which would cause another lockdown. It would be interesting to see what happens to the economy and inflation rate as winter progresses. Now I'm going to pass it off to Sanket, who's going to talk about the Fed.
Hi, so I'll be looking a little bit into the government response and potential implications. So just to summarize here, in March, the Fed cut rates to 0%, and they introduced this $2 trillion stimulus with the government, which the other group went over, but this is essentially how it was distributed. And I'm going to be digging a little bit into the implications, and mainly there's three concerns here. There might be some inflation, there might be some deflation, or as someone mentioned in the chat, nothing might happen and we might not see either one of them. So on the next slide, I wanted to put this into context here. So as you can see, the money supply has kind of increased linearly for the last decade, and then all of a sudden we see this massive uptick in money supply, mainly due to the stimulus. So the money supply increased almost $2 trillion or $3 trillion, which is why some people are scared that we might see inflation on the back end. And as Gabby mentioned, inflation does tend to lag a little bit. So there's not exactly like an answer here so far. So there's a lot up in the air, which is why I'm going to be digging into it. And then on the next slide here, putting the Fed funds rate into a historical context, as you can see, after 2008, it's mainly remained very close to zero, and then they kind of increased it a little bit, and then have cut it back down all the way now to 0%. And the main reason why I wanted to point this out was just to show that, once Fed rates are at 0%, the Fed really doesn't have as much power as they used to, as they kind of get to that lower zero bound where maybe they're approaching negative rates, which kind of complicates things in the economy in terms of like banks and things of that nature. So they don't really have much leverage in terms of cutting rates even more. So they're going to have to kind of explore other options in their toolbox. But I think if we get inflation, which is what I'm going to be exploring first on the next slide, kind of looking into, who are the winners and who are the losers of this, or who would benefit the most. So the winners of inflation mainly would be people who have debt at a fixed rate. So maybe, people who have mortgages that are locked at really low rates, such as like 3.25%, which is where a lot of people have been like refinancing their houses, or people who have assets, just given that, whether that be the stock market or like a house, asset prices tend to increase with inflation. So that helps them. But I think there's far more losers if there is inflation. So the first and probably most important, I think, would be that most workers would be losers, just given that a lot of people don't have much control over their wages. And if you keep wages constant during an inflationary period, their real wages decrease. And then also people who are savers or retirees, if they're not getting much return on their cash, their real buying power tends to decrease, which is an issue for a lot of people, especially people who are closer to retirement. And then lastly, the entire economy kind of suffers just due to uncertainty. Uncertainty is not a great thing for the economy. And looking on the next slide here, I kind of broke down, how wages have changed over the last couple of decades. So on the left, we can see even though productivity has increased by a good amount, hourly wages haven't really increased too much, which kind of makes me think that, most people don't have control over the wages, as I mentioned in the last slide. So inflation would really hurt the typical worker. And then even more so, if you look on the graph on the right, it looks like the bottom 90% have seen very little uptick in their wages, while the top 1% has been the group that has seen the most increase in wages. So if there were inflation, it looks like the bottom 90%, and even more so the bottom 50 and bottom 10% would be hurt most from the inflationary period, just given that they have the least control over their the wages. So the reason why I bring this up is because obviously the stimulus is there to help the lower income people rather than the top 1%. But it looks like if there were inflation caused from the stimulus, that same group would be hurt the most. So that's something to keep in mind, at what cost is the stimulus coming? And then looking a little bit into the other period, as Gabby mentioned on the next slide, we might see some deflation. There was some deflation in 2009, and this tends to happen, in a recessionary period by definition almost. So looking a little bit into the winners and losers here as well. So initially consumers would benefit from this. They see prices decreasing, so their purchasing power goes up. People who have a lot of cash tend to see their real wealth go up, just given that everything else is cheaper, but they have the same amount of money. And then workers with near minimum wage jobs would be winners, actually, since employers would not be able to lower their wages anymore, but everything around them would be getting cheaper. So I thought that was really interesting. And then the losers here, the entire economy would be a loser, just given that deflation tends to cause deflationary spirals where, people see things getting cheaper, so they stop spending in hopes that, they'll buy something next week for a lower price. And this causes a cycle where people aren't spending money and the economy kind of comes to a halt. And then another loser would be, again, employees who have less control over their wages. So on the next slide here, starting with the one on the right, I kind of found, what percent of Americans work federal minimum wage jobs, and it was actually a lot lower than I thought. So it looks like there's 2 states, that are maxed out, but other than that, it looks like pretty much every state is less than that 4% mark. So even if we have deflation where minimum wage workers are benefiting, which is, the lowest income bracket, it's really not a very large proportion of the population. So they would be hurt. And even more so on the left here, if you look at how wages have increased between, the high wages, middle wages, and low wages. So essentially the other chart from a couple slides ago, but broken down more so, the lower you go, the less kind of control they have in their wages, which is why they've kind of seen either stagnant or declining wages. So I guess my fear would be that if there's deflation or inflation, again, the middle class and the lower class would be hurt most by it. And then last kind of scenario here, which someone mentioned in the chat, we might not see any change, any inflation or deflation, and I think that's been the case so far for the most part. We've seen. I think the general idea is that because the U.S. Currency is kind of the standard in the world, there's always demand for it, which has kind of helped keep it away from any depreciation or appreciation, and it's been fairly priced. And in that case, things are normal, and the stimulus doesn't really have any side effects. But generally, between the inflationary, deflationary situations, I kind of wanted to think about, at what cost are we introducing the stimulus package? In both cases of inflation, deflation, it looks like it hurts the middle and lower class, which it's meant to help the most. So, are there any ways we can kind of introduce a stimulus or structure it so it helps these people rather than hurting them if there's any side effects? So maybe a smaller stimulus package, but more targeted towards the lower income brackets, or if anyone has any ideas, to throw them in the chat or to speak up. So that's all I have. Kind of wanted to make it an open discussion here. I see there's a kind of a conversation going in the chat here.
Do you want to read a chat or two and talk about that?
Yeah, Peter, do you want to kind of go off about what you guys have been talking about in the chat so the rest of the people can see it or learn about it?
Yeah, sure. I guess, Professor Miller posed the question about what has happened to luxury goods and the prices thereof. I think we've seen prices of most goods fall. Luxury goods are obviously a little bit of a special case because they're not just like kind of your normal everyday goods where inflation rises and then demand for the good rises necessarily. I think, a couple things are important to consider. First, who's consuming luxury goods? It tends to be wealthier individuals. And as was brought up in the chat, wealthier individuals were probably hit less hard than less wealthy individuals because of the pandemic. Gabby also brought up the point that, certain retailers, now that kind of things are more settling down, let's say, than March or April, certain luxury retailer or luxury goods, not luxury retailers, are increasing prices like Chanel or Louis Vuitton. And that's to try to make up for, kind of the loss in in revenue that they've likely experienced. I think definitely luxury goods were hit on the front end of the pandemic. But I do think it is important to say that luxury goods are kind of less elastic or less less flexible in response to changes in income or changes in consumer behavior, consumer spending. And then David brought up an interesting point, and it looks like he just sent another chat which I've yet to read. But David's talking about how we've put 3 trillion into the economy, and we're kind of not seeing inflation rise maybe as quickly as as the government hopes, or as a lot of economists foresaw. This is we've actually, to the contrary, we've seen lower rates of inflation. We've seen declining rates of inflation. And of course, I think all governments are a little wary of hyperinflation, or of kind of prices of goods increasing too much. But again, inflation can be an indicator of a kind of a healthy economy. Personally, I think in the US, kind of the reason we've seen this is because we are kind of still in the very midst of the pandemic. I think probably in the next year, we'll see a much greater spike in inflation, maybe even 2 years down the line. I think kind of just from a fundamental reasoning approach, this is because, we see the stimulus checks, and we see the other money, the money supply increasing by the Fed, by buying up bonds or whatever other kind of mechanisms they're using. And I think a lot of that money is kind of just being held onto. We talk about like money being pumped into the economy, but really it's being pumped into people's pockets, and then they have to go out and spend it in order to pump it into the economy and, incur growth and, affect inflation. I think, I don't know when exactly, and this is definitely up for people to discuss, but I do think sometime a little bit in the future, we will see kind of those inflation rates go to what they're more expected to hit.
Yeah.
We also saw the Fed, they changed their inflation mandate like probably a month ago. I think they changed it from I could be getting this backwards, but from like an average annual rate to I'm actually forgetting, but someone might know, can put it in the chat. I know they definitely changed their approach to price stability, which probably indicates that they are expecting a degree of inflation.
Also, one thing I kind of wanted to point out is the reason why people think there might not be any inflation or deflation, or at least inflation, is because currency is all relative, and because every country was kind of printing out money like crazy and introducing stimulus, it might all just end up balancing out in the end, and we might not see any differences. Again, so that's always a possibility. I think that's what people are implying to, that we haven't seen inflation. And also about the Fed mandate, I think it was the other way. They usually target a 2% on an annual basis, but they've kind of gone to this, like, they want an average of 2% over the next like 5-10 years, which kind of shows that, even they are uncertain about what's going to happen. That's why they're kind of leaning away from this target rate and going towards like an average or a floating 2%.
So I have a question.
Yeah.
In terms of, trying to find prices on items, are all items prices allowed to vary and reach market equilibrium, or are there certain products whose prices are not allowed to change? And how does that affect things?
So are you referring to like, price gouging, where typically when there's more demand, you'd increase prices, but some, like by federal regulations, they're not allowed to increase those prices?
Yes.
Yeah, I don't know, Peter, if whoever took GDP maybe wants to take into this, but that's definitely something that does happen for necessities.
Yeah, I think we saw that kind of with like the resale of a lot of items, because obviously that's something that's less regulated, and also something that's more enabled by places like Amazon and other online retailers. I remember back in March, and I'm sure all of you do too, little bottles of Purell were going for $80, or $180, on Amazon or on eBay or whatever kind of like secondary retail site we saw. But as Sanket mentioned, there are federal restrictions that kind of do prevent price gouging to an extreme, or on specific types of goods. Yeah, I'm not sure where you want to go with that, Professor, but happy to answer something else.
That's basically where I was going. It was exactly the example of the Purell or the masks or even toilet paper. You have, those funny memes where people are meeting in the back of a building and exchanging, money for toilet paper, stuff like that. And so
Yeah.
it's interesting to see how much those protections make a difference in terms of what goes on, because one of the things that has been talked about by both groups is how the pandemic response is not affecting everyone equally. And when you look at, what fraction of your income goes to necessities, there's a huge difference depending on where you are in the economic spectrum and which products are you buying.
Yeah, I mean, I would probably argue that those, like what we saw with the Purell and the toilet paper and all that, I feel like that was more created by the mass hysteria that we saw kind of at the front end of the pandemic, and less maybe by, like actual price gouging or that is to say that I don't think it was actually an appropriate, indicator of our productive capabilities as a country or as a globe. And obviously, that's historically deterministic of me because we've seen, there is enough toilet paper and there is enough Purell for the most part. And, those prices have now, become stable and aren't spiking anymore. So I think that's, a lot of that's kind of just, that fervor and that hysteria and anxiety that was really, really heavy on the front end of COVID, and maybe rightly so, but definitely, kind of driven and spurred by kind of media and different kind of different entities and mechanisms that we've talked to and that other groups have presented about.
I just put in the chat a link from Snopes about the Johnny Carson and the toilet paper shortage of 1970s. And it's interesting to just look at how things can get a life of their own. And when people feel that there's not going to be enough of something, even if there is going to be, what consequences that has. So we have time probably for one or two more questions.
There was one question posed in the chat earlier about retail vacancy rates, and I want to address that. So in the second quarter of 2020, retail vacancy rates in the US were reported at 20%. And I don't know too much about what those figures exactly mean, but I compared to previous quarters, the typical retail vacancy rates have been at about 9 to 11% on a quarterly basis over the past 4 quarters before Q2 2020. So the vacancy rates doubled. And this has gone hand in hand with an increase of about 10% in demand for industrial retail warehouses. And that kind of goes in line with the trend I discussed earlier about the movement from brick and mortar to online retail. And so that is shown in the shift from brick and mortar retail to these industrial warehouses that serve online platforms.
Any final questions? All right, thank you, everyone. Have a great day.